Hello, and welcome to a new episode of the Energy Connects podcast with me, Chiranjib Sengupta. As the world pursues the road to net zero, companies and executives at the front line of the energy transition are getting increasingly sober about the transition's practical realities. In fact, according to Bain's annual Energy and Natural Resources Executive Survey, confidence in the world's ability to achieve net zero by 2050 looks to be eroding. And to discuss more about that, I'm delighted to be joined by Grant Dougans, partner and lead of energy and natural resources at Bain Company. Thank you so much, Grant, for joining us, and great to have you back on the Energy Connects podcast.
Great to be here, and Happy New Year, Chiranjib.
Thank you. And to start off, you recently published your annual survey of energy and natural resources executives, where while they are going on with transition-oriented growth businesses, they're also increasingly looking at 2060 for achieving the global net zero emissions. Why is that?
Yeah, it's a great question. I think, so just a little context, our survey is about 600 senior executives from around the energy and natural resource space. So agriculture, chemicals, mining, utilities, oil and gas. And so we do this every year. And one of the things that we ask each year is, when do you think net zero will happen each decade? And one of the things that really came through from this year's kind of outcomes, if you will, is that a meaningful shift of executives saying 2060 or later is kind of their best view of what's going to happen. I think we're now like 2/3 of executives in the space are thinking 2060 or later is the most likely outcome. I don't think that's a reflection of intent, if you will. I think in general, executives understand the importance of 2050 net zero, but I also think it's a reflection of the realities and the fact that each year that we do these surveys, we're a year closer to 2050. And many of these projects that are underpinning the transition are projects that take 5-7 years to build. And so I think what we're seeing and what we saw in the data is executives recognizing some of the challenges of the scale of the infrastructure required to execute this, anything like a net zero transition. In particular, one of the questions we also ask each year is, what are the key impediments? What are the things that are holding you back from sort of driving more low carbon growth? And the biggest thing this year, again, as was last year, was willingness to pay of the customer and return on investment and the ability to generate returns on projects. And that was the single biggest increase of any topic in our survey, a 14-point jump. So now 70% of executives say that ROI, willingness to pay, is a major barrier to growing more quickly. And I think there's a number of factors there, including, importantly, the impact of interest rates. And the single biggest cost driver for most low carbon projects is capital. And so when you increase the cost of capital meaningfully, the amount of revenue customers have to pay to fund those projects goes up meaningfully as well. And so I think you're starting to see some of that kind of reality flow its way into how executives are viewing the transition.
That's a very interesting point. And so how do you see, for example, impacting clean energy investments in the long run, given that, the willingness to pay is becoming an increasingly huge factor? And do you see, for example, companies moving away or balancing their transition-oriented businesses?
It depends a lot on what industry and what sector you're talking about. We talked about this in our last conversation, last year. Despite executives viewing transition as taking longer kind of across society, they remain quite optimistic about their individual low carbon businesses. And we see that in our client work as well. Even if the world doesn't hit net zero until 2060, there's a tremendous amount of investment opportunity out there to go after. And companies continue to try to find ways to capture that profit pool. But we don't see companies shifting more and more capital each year into these low carbon spaces. You still see like 75% of the capital is going into the core businesses they have today. 25% is going into the new space. To hit something like 2050, you would need to see a really large and very quick shift of that capital base over. And so I think it would be a mistake to assert that there's not opportunity here. I think executives continue to see a lot of opportunity, but every project that needs to be funded with debt or equity, which is all of our projects, is more expensive, and that will tend to reduce the number of available projects, at least in the near term, but it should not impact the long-term trajectory.
Now, given that ROI is emerging as a challenge to, let's say, decarbonization, what could enable and what must the industry do more to make sure that the return is really attractive?
Yeah, I mean, there's a lot of elements to that. You think about it as kind of the revenue side and the cost side. How do you make these projects work, right? I mean, again, energy transition, is really about project economics. It's about building power plants. It's about building assets. And so, on one side, there's an important role for policy to play in that. You can create the revenue pools to fund these investments via policy mechanisms and a wide range of those. And when we ask executives about policy in the survey as well, they shared that policy certainty is one of the most important factors supporting this. And so I think part of this is ensuring that you got the right policy landscape, at least around where your businesses are playing. And so thinking about where you want to be from a policy perspective is important. What jurisdictions do I want to have my businesses in? But also the cost side, right? I mean, capital projects, there's a long history in many industries of capital projects going over budget, being delayed. And so a lot of the work that we're doing with our clients now is really taking a closer look at how capital projects get done. How do we lean out capital projects? Do we need all the functionality in all of these assets? How do we make sure that we do deliver those things on time and on budget every time? We think there's a role to play on the cost side as well, in addition to the revenue side, to making these projects work.
Right. So that basically means there's also going to be a lot of focus on the efficiency side of the business.
Yes, exactly. And that's, efficiency matters. And, especially when capital is more expensive, efficiency in capital particularly matters a lot. Whereas I think historically, a lot of the focus has been on OpEx, where executives spend a lot of time thinking.
And from that perspective, Grant, how would you describe the current global landscape for green energy investments? And in light of all the conversations that we've heard earlier this year about, whether the transition is picking up pace, it's happening or it's not happening.
Yeah, I think that's, one of the main messages again from the survey is, while overall people are seeing the global transition pushing into 2060 and later, given the complexities, there are real opportunities out there in the world to invest. Whether a project works or not is not a global question; it's a local question of the jurisdiction you're operating in. We talk a lot about the fragmenting energy transition. That concept, I think, is really continuing to play out. We asked in our survey what region is most attractive for investment. I think that makes this point. And North America comes through as the most attractive region for low carbon investment or energy investment globally, certainly much more than some other regions. And not just in totality, but from every other region, they are viewing North America as being really attractive. And so you're seeing European players thinking about how they get into North America, et cetera. So there are real pockets of opportunity out there in the globe for low carbon investment, but becomes very quickly a national or subnational question. And so for executive teams thinking about, how do I have a bead on what's going on with policy? How do I know what's going on in these regions at a much more local level than maybe I have had to do in the past for these types of businesses?
And since you're very closely associated with this survey, in your view, what would be the main difference that you see this year from the results of last year?
Yeah, I think the biggest things for us, again, is this concept of delay, a recognition of the challenges, overall, a view of 2060 and beyond, at least, again, how executives are seeing things play out, the importance of ROI. And I think every year we try to tune the survey to make it more useful, right? That's part of what we're trying to do. We're continuing to try to get that to be more and more local, because again, the transition is not a single global transition. It is hundreds, if not thousands, of subnational transitions. And so I think having this view of the different regional views, I think was really important. And the notion that North America has really emerged as a tremendous investment space for energy of all kinds, I think was a key finding for us this year.
I think that's an excellent point, because as we talk about the global energy transition, I think we sometimes miss the point about the local implementation of that, without which there is no transition.
Yeah, I think that is a mistake that, certainly this year, I think about CERAWeek, I think there's more dialogue about the challenges of transition, but I think it would be a mistake also to assume that transition isn't happening globally or anywhere, right? There is real opportunity out there, but it requires being more localized, getting those pockets of opportunity more so than ever before. Getting that development pipeline set up in some of those attractive jurisdictions.
That's a fair point. And one of the enablers of the transition increasingly is AI, and especially generative AI. And what do you see as its impact on energy businesses going forward?
Yeah, and this again another topic we cover in our survey, but we are bullish on generative AI as a real transformative, as we talked about earlier, efficiency technology, and that could be anything from for utilities, customer service functions, right, to regulatory filings, to engineering drawings, to even to operations. There's real opportunity to drive efficiency through generative AI. There has been a lot of dialogue about the role of AI as it relates to the transition, separate from running the businesses. And again, when we asked executives about that, we didn't pick up a lot of beliefs that AI would have a strong role to play in accelerating the transition. And that makes sense to us. The transition is about building stuff. It requires land. It requires communities to be amenable to building stuff. And that's really not the kind of stuff that AI is particularly helpful for. But of course, the issue of AI data center and the load required to serve AI is a real, I'll call it trend that's emerged in the last 12 months as a real consideration. And so there's puts and calls in terms of the role of AI in the actual transition itself. But not to say it's a tremendous opportunity for individual companies, but again, for the overall transition, I think it's probably more of a mixed story.
Well, it's certainly a more optimistic note than the top line, which is about transition moving, or the net zero goal moving 10 years forward. So yeah, thank you, Grant, for your time with us and for your excellent insights.
Of course, we'll hope we'll do it again next year.
Absolutely. Thank you so much.
Thanks, Jared.
A big thank you to everyone joining us today. You can always get comprehensive coverage on the energy industry at energyconnects.com. I will be back with more guests from across the industry in the next episodes of the Energy Connects podcast. Until then, goodbye.